Welcome to Apartment Market Dynamics from NPF Research. I'm Jay Parsons and I'm with Greg Willett, the head of research and analysis at NPF Research. And today we're talking about the recovery markets. 2010 was such a strong year for the national apartment sector that even the hardest hit markets began shifting into recovery mode. All but one, but we'll come to that later. Before we get into 2010, let's look at how we got here. Here's a list of some of the hardest hit markets. You'll see this is a ranking of revenue change from 2008 to 2009, revenue change being the combination of same-store rent change and occupancy change. And at the top of this list is Phoenix and Las Vegas. Revenue's down more than 17% in that 2-year time period, and followed by Atlanta, Los Angeles, the Inland Empire, and Jacksonville. And I should note that there would be a few other markets we could put on this list that were hit hard in that time period, places like San Jose, Seattle, Austin, but the declines in those areas were steep and very brief, and they're already humming along. So Greg, when we look at this list here, we see a lot of the housing bubble markets. Is that the common denominator? And if so, how did the problems in the single-family home sector extend to the apartment market so quickly?
You're right that the housing bubble markets are the theme there, and that really comes down to what we saw in that time period, huge job losses overall in those metros, and certainly that impacted apartment renters as well as homeowners.
Okay, so let's fast forward to 2010. 5 of those 6 markets saw revenue change turn into positive territory last year, and in 2 spots, Jacksonville and Phoenix, revenue growth actually exceeded the U.S. norm of 4%, even though occupancy rates remain pretty terrible. Greg, let's start with those 2. What do you make of Jacksonville and Phoenix? Are those recoveries for real?
For Jacksonville, I'd point out it is one of those markets where really the recovery seen so far has been right at the top end of the market, and that reflects that they were late in the cycle finishing up construction, so we've now had those recent deliveries finally make it through initial lease up and get us a little bit of pricing power at the top end of the market. But, you know, in the big picture, we're still just kind of moving households from one housing type to another in Jacksonville. So has any real progress been made? Not a whole lot. On the other hand, I'd contrast that with Phoenix, where there I would say the recovery is real. And what we see in Phoenix, it's already come back close to the top of the charts on employment growth, so you really are adding households and some really significant momentum there. And as we always talk about with Phoenix, you've got that big split between what you're seeing on the west side versus the east side. On the west side, a lot of housing overhang there. It's just going to take a long time to catch up there. In contrast, east side suburbs like Scottsdale, Tempe, Chandler, Gilbert, you've got some really meaningful progress, and the apartment market in those submarkets is really positioned to do well the next couple years.
Let's move a little further west to Southern California. We saw the Inland Empire and LA on that list, and we could put Orange County and San Diego on that list as well, because revenue growth was pretty minimal in 2010. So what do you make of Southern California?
It's interesting. I think that Southern California is a tough call as we move ahead. If you look back historically, the progress in the economy has always been really closely tied to general consumer spending, as well as what happens in the for-sale housing market. So we think that there are some questions on what the economy is going to do here. And in general, we're not quite as optimistic as some of the leading economists are. And so that means for us, we would probably put Southern California in, at best, middle of the pack in terms of apartment market performance as we go into the next couple of years, versus a lot of analysts actually expect those markets to soar back to the top of the charts.
And I should point out, as you saw on that chart there, that occupancy rates are pretty strong across Southern California, but revenue growth, especially rent growth, just hasn't been notable at all in those areas. And Greg, how about Atlanta? Is this just an overbuilding issue, or are there fundamental concerns you see deeper into the data?
For Atlanta, there is some good news, and that is the economy is really making some progress there. The bad news part for Atlanta is that builders, and whether you're talking apartment builders or single-family builders, they are just chomping at the bit to get going again on construction now that job gain is making a little bit of progress. And so I think what happens there really kind of ties to that construction level. If they'll hold off for 2, 3, maybe 4 years, Atlanta could be a really good story. If they plunge right back in and start building at significant levels, this one's never going to recover in the overall picture, although you would have some niche opportunities.
And let's close it out with Las Vegas. This is the one major market that did see revenues fall again in 2010, down another 4%. When will we finally have some good news in Las Vegas?
Well, let's define good news there. I mean, if good news means that revenue change goes back into positive territory, then I think we're coming right up on that right now. If good news means that you actually get revenues back to the levels that we saw in 2006, 2007, you're a long way off from there. I mean, maybe 4 to 5 years. And it is a market where employment growth in this next cycle is just not going to be anywhere close to what it was during the peak years.
So that wraps us up for the recovery markets. Until next time, for Greg Willett and MPF Research, I'm Jay Parsons. Thank you for watching Apart Market Dynamics.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.